Today, I'm going to give you 5 tech stocks that are ready for the buying right now. But first, let's look at the times we're living in and the major things affecting stocks in general before we dive into those 5 tech stocks, which are good buys and are undervalued. That is so important at this time that you get good growth prospects, but they're undervalued and relatively safe at the same time. The best of both worlds. The Federal Reserve has formally acknowledged Taylor Swift's concerts as a major economic contributor. They say her concerts are adding 4.6 billion to the economy. Philadelphia hotels are talking about the T Swift lift effect of her concerts selling out stadium after stadium and the hotels filling up. So she's having a major effect on the economy in general. And she's selling out concerts wherever she goes. Barbie, the movie, has made 500 million in 9 days. The theaters are back for now. Japan ruined the stock market last Thursday because they acted like they were threatening to maybe raise their interest rate. But on Friday, they completely undid that. They indicated that, well, inflation is no big deal, and we're not going to raise the interest rate anytime soon. In fact, we see inflation continuing to go down, and we're just going to keep our interest rate at a negative 0.1%. Wow. Japan is a big deal, in some ways a bigger deal than China, just because they own not most, but a lot of the United States debt. They own 1 trillion of United States treasuries. So whatever they do with interest rates affects the United States a lot, and it's affecting stocks a lot. If they threaten, even mention that they're going to raise interest rates, our stocks will be affected in a downward manner. Whereas if they say inflation's no big deal, we're not going to raise interest rates, that's very bullish for United States stocks. The strange world we live in. Semiconductors are the new oil in this modern age that we live in, and they need more expensive and increasingly complicated semiconductors for artificial intelligence. Artificial intelligence could extend this bull market considerably. Jeremy Grantham, who is very bearish on the market in general and talks about a super bubble and how things are going to crash and so forth, but he admits that artificial intelligence will probably continue the rally for at least another 3 or 4 months. So we have these very expensive chips being sold by companies like NVIDIA. NVIDIA is selling some chips for over $40,000. So it's really incredible. The super microcomputer, which makes servers and other computer equipment involved with artificial intelligence, are selling some equipment for like $140,000. So there's big money to be made. And some are saying that we are actually at the beginning of the semiconductor explosion because of the complex semiconductors that are needed for artificial intelligence. A safe way to invest in semiconductors generally, if you don't want to pick the individual stocks, would be an ETF like SOX. That's SOX. And the more risky thing is to triple leverage it with SOXL, which gives you $3 for every dollar that the semiconductor index goes up. So we have some very exciting times coming. Semiconductor equipment manufacturers are on fire. They make the equipment so semiconductor companies can make the chips. And one that I've followed since early on is Super Microcomputer. Okay, its symbol is SMCI, and it is super. Since I began covering it, it's more than tripled. It's out of this world growth. And the semiconductor equipment makers are the first in the semiconductor cycle. They are the first to go up. And its price right now is $335, but it's still undervalued. They say the value is like $378. Its PE is not out of this world. It's 27, but that isn't bad when you consider that its earnings growth rate is a supercharged 36%. So this is still a buy, amazingly. And looking at the chart, Super Microcomputer has more than tripled year to date and is still within its Bollinger Bands and has a relative strength of 78, which is excellent. I think there's more to come with this stock. I think we have underestimated the big effect artificial intelligence will have and will continue to have. Another semiconductor equipment maker at a more reasonable price is Photronics, whose symbol is PLAB. Its price is 26. Its value is at least 32. Its price to earnings, though, get this, is 12. Wow, that's very low. But it still has an excellent earnings growth rate of 20%. So this is one for the future. And looking at the chart, Photronics or PLAB has gone up 55% since the beginning of the year. Wow. And it's still within its Bollinger Bands, and its relative strength is 62. So we have a winner here. ST Microelectronics, symbol STM, is a semiconductor maker. I think of them as making practical semiconductors, and they make a lot of semiconductors for cars. It's a very good value. Its price is about 53. Its value is thought to be 73. Its price to earnings is very low. It's only 13, and it has an earnings growth rate of 23%. So this is an excellent buy. And looking at the chart, ST Microelectronics is in the upper part of its Bollinger Bands, and its relative strength is 63. So this is a buy. ON Semiconductor, symbol ON, has long been a favorite of mine. I frequently think of it as Old Faithful. Its price right now is around 105. Its value is about 130, and it has a relatively low PE of 22, especially considering its excellent earnings growth rate of 22%. So this is an excellent semiconductor manufacturer that I don't worry about too much. It's just kind of a steady performer, which is going to do even better now, I believe. And during 2023, ON Semiconductor has been an excellent performer, and it has gained 68% year to date. Wow. It's near the top of its Bollinger Bands, and its relative strength is about 65. This is still an old faithful buy that I return to over and over again. The fifth undervalued tech stock I have for you is Broadcom, symbol AVGO. Its price is around $900. Its value is around $954. Its price to earnings is only 22, and its earnings growth rate is 22%. This is a mega cap stock that's sort of ignored. It's not ignored, but it's not talked about as much as the other mega caps. I mean, its market capitalization is $371 billion. You would think it would get more attention. And it's so vital to the software infrastructure of the internet. Plus, they are making very complex artificial intelligence semiconductor chips, so they benefit from that strongly. And looking at the chart, like the previous 4 tech stocks I've been showing you, they're all undervalued. They all have wonderful charts, and it's going to continue to do well. I think this is such a major company. It's so vital, and its relative strength is only 60, and it seems it pays a pretty good dividend too. So I love this stock. I think it's a steady performer. I think it's one of those you don't need to worry about that much, that it's going to follow the semiconductor trend, and especially since they make complicated artificial intelligence chips, I think this stock would do well. And of the mega cap stocks, I like Google and Meta. Google and Meta had the best earnings reports, and they also have the lowest PE of all the mega caps. Google has a price to earnings of 23, while Meta has a price to earnings of 28, and that's relatively low for mega caps. And looking at the chart, you can see both of these mega caps have done outstandingly well. Google has gone up about 50%, and Meta in green has gone up 159%. So it's been quite a year for the mega caps. And finally, we have a clip from Bloomberg that sums up all the relevant inflation data and all the data you're dying to know about the economy.
We got some big numbers this morning that are important. We've got the employment cost index coming in a little bit lighter than anticipated and down from the prior quarter. It comes in at 1%, down from 1.2% in the first quarter, which would be good news for the Fed. We'll get the breakdown on that and see what the wage component was in just a moment. Personal income rises 0.3. That's a little less than last month's 0.4, and down from the 0.5, the 0.5% that was anticipated. Actually, the May number was revised up to 0.5%. So slowing there, but we did see that in the overall GDP numbers. Spending comes in at, as I said, 0.5%. Real personal spending at 0.4. So not a huge inflation effect. And then those PCE numbers that everybody from Lisa to Jay Powell are watching. The deflator comes in, the headline number comes in at 0.2%. That's a little bit faster than last month, but it was what was forecast. And so on a year-over-year basis, headline PCE is 3%. The core is 2%, 0.2 gain. So that comes in at 4.1%, and that's lower than anticipated and certainly lower than 4.6% last month. So, Lisa, we've got basically the same story we've had for much of this week. The data come in line kind of with what the Fed wants. Not all perfect, but better than it has been.
Mike, when I'm looking through these numbers, it does seem to confirm this Goldilocks scenario of slowing growth, slowing inflation, but still robust consumer spending. How reliable, how significant is this data showing an upside surprise of personal spending even as incomes fall off just a touch?
Well, it's kind of what the story we've been seeing. It is interesting that we get a little bit of an upside surprise in personal spending because the GDP numbers suggested consumer spending had fallen off. So maybe that was weakness in April and May, and June comes in better, which sets you up for a little bit better spending going into this third quarter. And obviously we've got back to school coming up, which will be an important measure for retailers. The other numbers that come in better than expected, they're not going to have a huge impact right now because we get a lot of data between now and the next Fed meeting, but it does show that things are going in the right direction. And so maybe Jay Powell gets the board of governors together and they'll go out for happy hour today or something.
You've been digging under the numbers. What do you see?
Yeah, let's look under the hood at a couple of things that Jonathan was talking about. The ECI for wages goes down to a 1% gain from a 1.2% gain in the first quarter. And that would be considered reasonably good news. But then when you look under the personal income figures, wages went up 0.6% in the month of June, and that is up from 0.5%. It is actually the highest increase since January. So we have two sort of contrasting views of what wage pressures are doing at the moment. And John mentioned, as we do every time we get an inflation figure, the super core, which is Jay Powell's favorite thing. Core services ex housing comes in at a 0.2 gain, 0.22 if you want to round it out to three figures, and that puts it at a 4.1% increase for the year, which is going to be your lowest since basically last August. So things moving in the super core direction. Take out housing out of the equation, and services for the PCE, like the CPI, are down. But the wage numbers still healthy, and that suggests consumers can still keep spending. The question is, will the Fed see that as inflationary?
So we're having a big rally now. The question is, are we emotionally prepared to ride this bull? It's time to get your spurs on and hang on to the rope as hard as you can in this rodeo, because I think we're in for a wild ride. Thanks for listening and watching. Be sure to like and subscribe, and I hope to see you in the next one.